Good afternoon, everybody. How are we doing today? Welcome to this afternoon's first live webinar. I'm your host, Alex Chisnell, as always, and I'm joined by Nikolay Piriankov, CEO of Taylor Hart. So we're talking raising funding during lockdown today. Those of you who've been with us over the last month or so will have met a number of entrepreneurs that I've chatted to who have managed to raise funding during the current lockdown. And we've also had different financial institutions on talking about the different government-backed schemes that are out there as well. And we had Magnus Grimmeland from Antler, the early startup VC, also talking about funding and how many of the startups that they look after have been getting funding as well. So there definitely is money out there. It's trying to find where it is. And those of you who are familiar with me will know Nikolay's a guest on the Screw It, Just Do It podcast a couple of years ago now. We've kept in touch over the last couple of years and seen how well he's been doing in growing his business. So Taylor Hart, for those of you who haven't come across before, an award-winning London jeweler specialising in custom engagement rings. Correct me if I'm wrong, but you've got like physical premises in New York as well as London.
Yeah, it's the kind of product where we started. Thanks, first of all, for the intro, Alex. Always a pleasure to be on a live event with you.
Appreciate it.
We definitely went through this kind of paradigm shift where we thought we'd be fully e-commerce, and then for a product of this nature, we realized that we needed to do the best possible version of a hybrid model where we have physical presence. But we didn't want to go all the way to the point where we have a high street presence due to the cost. We didn't want to pass on that cost to the customer through a higher price. So we work through showrooms, which are basically in offices, but have a really kind of intimate and well-designed experience alongside them.
Yeah, and I have been to one of them. Been to the one in London. Am I right in saying near Bank Tube Station?
In the city, yeah, just around the corner from. Maybe we may have moved since the last one, but yeah, we have one in Mayfair now as well, and one in New York on 49th Street.
Awesome. Okay, thank you for joining us. We've got Socky from Cardiff, got Nasser joining in from London here as well. Yeah, that's great. Post up your URLs or your LinkedIn profiles. I always use this opportunity for people to connect on here as well, and then afterwards I'll be able to send everybody an email. So again, Nikolay, if you want me to personalize any of that, I can send everybody links on there either later today or tomorrow, etc. Okay, so without further ado, everybody, I'll just point you out in the direction of the chat box here, because there is a private question button and I've been getting questions on there, and I always say best bet is to put them in the chat box, and then Nikolay gets to see them as well as me. So for some strange reason, only I get to see the questions, otherwise via the question box. But yeah, without further ado, I've already focused the screen to Nikolay's presentation, talking about raising funding during the lockdown. And he has experience of raising funding a number of times already. Hi, Nick. Thanks for joining us as well. So yeah, you'll be able to see us in the bottom corners of the screen here as well. And then we will answer questions after presentation. And again, Nikolay, if you see any that you want to pick up on during, then feel free to do so as well. But without further ado, I will hand over to Nick.
Thanks, Alex. Yeah, if any familiar faces in the live chat, like Nick Garner is a mentor and friend, thanks for tuning in. So first of all, just as a full disclaimer, I don't believe that I'm an expert in fundraising. I just happen to have spent a huge amount of time doing it, and actually, I actually think that if I was really good at it, I'd probably have spent a lot less time. So it's almost like you're going to learn from all my mistakes and why I've taken this long and spent so much of my time in the company fundraising. And I hope that some of those lessons will resonate with you, and you don't spend as much time as I have, because I guess one of the biggest issues that I've found is, as a CEO, if you're disproportionately spending your time fundraising, then what's the point? You're not really spending any time using those funds to grow the business and execute on your strategy and vision. So I hope that some of these lessons will come through as part of the presentation today. Just a little bit more background to the company, so you have an idea of the context within which we are growing and raising money. My co-founder, David Sutton, and I founded the company late 2013. We basically basically wanted to disrupt a really broken space. Anyone who's shopped for an engagement ring or jewelry will know that most people are complete outsiders, never had the experience of buying a diamond ring before. And unfortunately, we find that the industry, to a large extent, takes advantage of customers in that way. And we wanted to add a level of transparency to the space, mostly around price and provenance. So we didn't feel like the margins that were being demanded by some of our competitors were reasonable for the product. And by cutting out middlemen and by not having the high street presence, we felt there was an opportunity there. But on top of that, we felt like the customer experience really could benefit from layers of improvements, one of which is customization. So we really specialize in giving customers a very bespoke experience where we'll handhold them through a journey and to design an engagement ring and then hopefully come back for wedding rings and other jewelry purchases. So that's a little bit about the company and what we do. Try and connect as much of this back to our funding journey and growth journey together, and leave at the end with where we are now and what I imagine is the fundraising space going to look like for the next few years. So we've done every kind of fundraising. When we launched in 2013, the website went live in October, and we had 4 to 5 months of runway. And it was perfect timing, really, that I found out at that point around SEIS and EIS and Seeders. And I had an introduction to the crowdfunding platform. We've had a really great relationship over the years, but as a consumer brand, a crowdfunding platform is perfect, right? Because most of the people really understand what you're doing quite easily. It's got mass appeal, and many of you can do a promotion like we did on Cedar, so that our investors who were in the market for engagement could get a discount. So it became partly a purchase decision, partly an investment decision. So we kicked it off with essentially the friends, family, and fools round on Cedars. I'd like to hope that there weren't many fools, and it was mostly people who are going to end up getting a good return. But truth be told, you're not really promoting an investment opportunity as much as this is something interesting I'd like to back or be involved in. That was followed up by an angel round at the end of 2015, where we also got our first kind of micro VC investment. And by micro VC, what I really mean is a VC that invests kind of like an angel. So it isn't necessarily preferred shares the way that some of your Series A, B, C investors would have. Sorry, if there's any questions, if I'm using any jargon that isn't clear, happy for you to stop me and I can try and explain. So it's basically a venture capital fund that invested alongside some angel investors. And we then used their investments to propel us into a growth phase for the next few years. Just to put some numbers behind that, our first round of investment was £200,000. Our next one was around 500. So still very kind of small amounts of money compared to what you may hear big consumer brands raise. And I think for the most part, 90% of startups are raising a lot less money than you hear about. And you kind of start thinking that you should be raising a lot more because of the big stories of the consumer brands that raise a lot more. But in reality, it's hard to raise big amounts of money, and a very small percentage of companies do. And it wasn't until really last year that we kind of connected the dots and did what we call Series A round, where we had a large institutional investor, active partners come in, lead a round. They had a bunch of preference shares on top of that. So when we exit, they'll exit first and make back their money. And we, at that point, we had grown the company to 3 million in turnover. So it was really like, 5.5 years for us to get to a point where we could do that. And I know a lot of growth stories are much faster than that, but most of the people I know and that are trying to grow companies vastly underestimated, like we did, how long it takes to build a business that can get real serious venture funding. I think we are more the rule rather than the exception in this case. A lot of companies don't even make it to this point because they failed before. So if anyone's thinking that it's taking far too long for their company, I think this kind of 3 to 5 years until we exit story is more like 10 to 12 for most people. Throw in a non-year with COVID, because I think that's what's going to happen for a lot of companies. If you're not going backwards, the best you may do is probably stand still, unless you're Zoom or Slack or one of these kind of companies. And then with the investment, we've now grown the company, and we're doing we closed off the year at about 5 million. So we're not quite this kind of hockey stick growth company selling a physical product to customers. with physical space means that we're not seeing 10% month-on-month growth, but we're aiming for about 100% year-on-year growth for the next 4 to 5 years. That's our vision. So we're not building the next Facebook. We're quite clear about what our vision is and what our objectives are. And I think that leads me really kind of well into the next slide, which is before you even raise money, I think you have to really have a kind of a think about whether your business is a business that is venture fundable. So a venture fundable business is a company that will have a minimum type of growth rate that will attract the risk that venture investors seek out, and the return, of course. Sorry, they don't seek out the risk that they are prepared to accept to seek out substantial return. And in my opinion, anything less than like a 15 to 20 times return on investment is not venture fundable when talking about like a 5 to 10 year trajectory. So a lot of companies, they want to grow organically. The founders want to be really close to ownership and control. It's really a control versus growth dynamic. In some cases, you can maintain a lot more control while you have rapid growth, but in most cases, it's a trade-off between the two. So the question around being venture fundable is really how big can you get and at what rate can you grow? And I think investors, one of the things I've noticed that one of the frustrations I've had is meeting a lot of investors that gave us a lot of great feedback on us as founders, which is very flattering, obviously, and nice, but at the same time, not investing in the business. And you take that personally. You take it as a feedback on you, and you think that they're not being sincere. But truth be told, if you ask the right questions of what would it take for you to have invested in the business if you believe in us as founders, they'll give you the answers of how big they want the business to be. So there's often a disconnect here between the vision you're painting and what they need as investors to grow. So for me, being venture fundable is the first, probably primary question you should ask yourself. And all of these points that I've highlighted here, if you just Google them, there'll be many more qualified people than me, that venture capitalists that go into discussions on how they see what companies are venture fundable. But I think a lot of people just assume that they're going to get on the startup bandwagon and that they are venture fundable just because they think they have a good idea. I think there's a big disconnect there between a good idea and a venture fundable business. In terms of the economics, and that's an important point to start off with. The next point is obviously around timing. This is a perfect time to talk about timing, but it's not. I don't only mean whether we're in a recession or in a growth cycle. I also mean in terms of the investor themselves. So even investors have cycles of raising money, deploying capital, and then reaping the rewards. And some investors will invest more at different parts of that cycle. So if an investor has already deployed all their capital or most of their capital, they may be far more strict on their standards on who they invest in. So trying to understand the investors you're speaking to, where they are on their investment cycle, that's a very important point around timing. But in addition to that, obviously, the kind of macroeconomic situation is really important. And the last piece around timing that I think is very important is where are you in your company's journey? So I made just a little notes for myself in terms of timing and how we thought about it. We always try to raise at a point where we were growing really well, but also hadn't run out of money just yet. And the point here is just around the ability to navigate the negotiation. If you look like you're about to run out of money, you're in a position where obviously the investor has a little bit more leverage on negotiating. So the best way to manage that is to try and achieve a certain level of growth while keeping burn manageable, at least from your existing investors, to keep supporting you while you navigate and close off a large investment round. And this really helped us. Our angel investors did really give us the backing when we raised our active partners round last year, where they said, take your time, we've got your backs. And having that relationship with an investor is critical, that you know that they'll support you while you're navigating a larger raise, that you won't run out of money and have to take on worse terms than you may have liked to have. And the last point, which I think is probably the most important actually, is how do you identify who the right investors are for you? So you think it's the right time, you believe you have a venture fundable business. How do you find the perfect investors? So I've broken this down into two sections. I think the first is what do you do in your research, and then what do you do once you're actually having that meeting with the investor? And I think from the perspective of research, there's just a few points that are important to me. First of all, and I'll just, as I said, I'll mention a lot of examples of where we made mistakes. I think the first mistake you make is that you look at the VC landscape, and there's a lot of very sexy investors, the kind of tier one VCs like Index and you Octopus, and you really want to get investment from them because it's you feel like they're going to be the best investor for you. For most companies, those investors aren't actually the right fit, partly because of sector. So it may be that they just don't. And the challenge we had as a consumer brand is e-commerce and consumer investments were really buzzing in the 2000s, but haven't really been that hot for investors in the last 10 years. And partly the reason, especially in the UK, there are different parts of the world. For example, the West Coast in the US deploys a lot of capital in consumer, New York to some extent. But for example, London, Boston, Berlin, much more interested in SaaS, fintech in general. And we just found that there weren't a lot of investors in our sector who invest in our space. And going and spending time with an associate or analyst at one of these big funds, they will meet you. They spend a lot of time meeting so that they can kind of piece together their understanding of the entire landscape. But most of them won't invest, and they'll know that they're not going to invest when they take the meeting. And that's really extremely frustrating to figure out later on, because you're there, pitching with all the passion, and you burn out. You only have so much pitching passion per day, as anyone who's been on a roadshow will know. So I think it's a waste of time to meet with people that almost certainly won't invest, and it's a very difficult kind of hard truth that you should close down your list to maybe a handful of investors. And there's something scary about that, because the minute you go from 100 to 5, it gets quite real. You're like, shit, I'm going to have 5 meetings. Sorry, but I'm going to have 5 meetings, and if all 5 say no, that's my hit list, that's my target list. So one of the suggestions I have here is consider potentially having a few meetings with less than perfect investors just to kind of warm up, but possibly in your space, and keep your top 5 for once you have a good momentum and good feedback from those investors. And in similar points to matching with investors, some investors invest in later stages than you are. So finding investors that invest at the right time for your business, that's an important point. And one of the hard things here is that many are moving up in levels. So there's a smaller number, in my opinion, investing at the kind of early stage, and more moving into A's and B's. So it limits the number of potential investors that you have. And that's, while that is a sad truth, it just helps going to the right people, as opposed to just kind of saying, well, let me go to more because I have a higher chance. No, you don't really have a higher chance. Most investors automatically disqualify you if you don't fit that criteria, but will still take the meeting. And probably the hardest lesson out of all that I had to learn is that some investors who are investing in companies of your size, that do like your sector, they just want you to be a bigger company than you perhaps think you're going to be. And then here you have an internal discussion and a decision to make. Do you adjust your vision, and do you paint a picture of a different kind of growth story? Whether that's credible or not depends on how well you've thought about it and have internal alignment. Or do you just search for the investor that currently fits your requirements? So in our case, our growth story does not go 5 million, 50 million, 100 million, a billion in 4 years. I would love for that to be the case, but I don't buy into that. I don't know. We don't have the thesis in our management team and the co-founding team of how we would do that. But we do have a story that doubles every year, and so far we've been executing quite well on that. So it turned out that most of the interesting investors that we wanted to speak to in the first case actually weren't that keen on this kind of this 50 to 100 million company. They wanted us to be £1 billion company. So again, that kind of disqualified a few investors and left us with a smaller number. And then the last one, as I mentioned earlier, is that do those investors have the cash now? Now, you may think this exercise is going to just disqualify a large number of investors, but actually what it does, and this is what was like a hard lesson for me to learn, is it creates the perfect list of people to focus your energy on. And the beautiful thing about this is that those people, because you've done the hard work of understanding the investors well, when you do meet with them, they actually often are looking for you too, because that you're the perfect company for them. So it just makes the whole experience much easier. And it was exactly like that with active partners. So active partners are more like a private equity than a VC. They don't invest in 100 companies and hope that 2 become unicorns. They like every single one of the investments to make a good return, but they're also not necessarily hoping that you become a £1 billion company. They are happy with a kind of more not as exponential growth curve. And
looks like Nikolay's just dropped out, so let me see if I can bring him back. He did say that he had some problems with his internet the last few days, but that it was all good today. So I'm just going to re-prompt him and see if we can get him back on screen. Any questions that you've got from watching this, please post them up in the chat box there. Thanks, Nadia, for your question. I'm going to put that to Nikolay. When we get him back, should hopefully only be another minute or so. I will copy and paste your question, but your question, Nadia, just to share with everybody, is based on your Nikolay's experience, what is the best way to approach business angels? There are many companies advertising access to angels networks. However, some of them are ineffective. I think I'll get Nikolay's opinion on this, and I think it's the same with getting investors. Is you literally have to kiss a lot of frogs before you find a prince, and it's the same for many things in life when you're literally just having to reach out to people and do your due diligence on them, because I agree with you. Local network to me, for example, people think it's a big network, they invest in lots of companies, but in reality they make very small investments down here in this part of the world when it comes to angel investments. I'm just going to try and get Nick back on. He's not live at the moment. I'm going to re-prompt him, see if we can get him back invited on screen. Yep. Okay. Okay, yes. Any other questions? Anyone here at the moment that is raising funds? Anybody in the process of raising money? Post up in the box here in the chat box that you can all see. Or if you have experience of having raised money in the past as well, post that up for me in the box. I'm going to check my email just to see if Nick has sent anything with regards to trying to jump back on and his internet connection. So bear with me while I literally just bring that up, but be great to have any questions up there. Okay, so I haven't got anything from Nikolay. I'm sure he's furiously trying to get, there he is, we've got him back. Okay, brilliant.
Sorry about that, guys.
That's okay, we've got you back. I know you mentioned your internet connection before. No, we haven't lost anybody. Everyone is still here. We haven't lost one person, so that is good. Could see the numbers down there. But yeah, just there we go. Got your application. But yeah, let us know, everybody. We did have a question, Nikolay, as well, which I will. Another one that's come through the private channel as well. So I've just put that out to everybody here, which was based on your experience, what is the best way to approach business angels? There are many companies advertising access to angels networks. However, some of them are ineffective. And I was saying it's probably a case of kissing a number of frogs before you find a prince, but you'd have more experience than me in when it comes to angel investors. I'm sure, Nick, you'd be able to answer Nadia's question there as and when.
Absolutely. Can you guys hear me okay? Is the connection a little bit better? Yeah. Maybe what I'll do is I'll talk, get a better speed like that. Okay. All right. So on the point of angels, it's a very good question. Luckily now we have websites like AngelList. I find AngelList quite good to go and look at companies that are similar to your company. So this is what we did. Companies that are very comparable in terms of size and industry. Obviously broaden that. So if if we're selling jewelry, I didn't just look for other jewelers. I looked for all kinds of consumer brands, e-commerce, marketplace, luxury, and I looked at who'd invested in them. And then there's two approaches. The first approach is, there was a fantastic tool when we were raising our angel round. I don't think it's around anymore, but I think there are comparables which would connect to your LinkedIn and it would tell you who is the perfect person to ask for an introduction. If you don't have the tool, you can still do it the good old-fashioned way, which is looking at similar contacts and trying to find someone that you know quite well that you may ask for an introduction. So that's the one way that worked really well for us. To be honest, we considered, but we never used angel networks where you go and you do the pitching days. I did do quite a few like free versions of that. So the Harvard Business Angels Club is an example where you can pitch to the committee, and then the committee chooses which companies come and do a presentation, and they do this once a month. So there's loads of free business angels communities. I don't like working with the paid for ones. I just think that the best angel networks are the ones that organically sustain these committees without having to charge for it. And there's quite a few of those. If you just Google and look at meetups, there's loads of different localized and kind of global. There should be an online one, Alex. What do you think?
100% there should be. And I'm sure, a lot of networking events and pitching events have gone online. I saw Antler, for example, who I had on this show, that the founder Magnus, that their first Singapore cohort was pitching for investment only beginning of this week or end of last week, I think. And I was out in Holland, in Amsterdam, for their pitching event last autumn. And there was like 100 Dutch investors and about 10 startups, or all tech startups, pitching for investment. So it would have been interesting to see how that model's moved online and what the interaction is like between potential investors. So it must be happening to a greater degree now. You think people have had 7, maybe 8 weeks to kind of pivot their business models, just like we have here from a live event. So yeah,
absolutely. So that's the one approach. And then if you can't get an introduction, sometimes you have to resort to the good old-fashioned email, LinkedIn messages, unfortunately. But to be honest, I found that for every introduction I've had, the other 99 attempts to get in touch with someone have failed. So I think getting an introduction is probably the best way. If you don't have that network to get introductions, then going to the events where the angels go and meeting them through these even if you go to an angel event where you're not pitching, there's almost always a networking session afterwards, and you just never know. Sometimes it's extremely serendipitous how you connect with people who like what you do, especially if you're in a pitching event that is for your sector. So again, if you're going to a fintech or an AI pitching event and you're selling a jewelry product, it's unlikely that you'll find a good fit, because those angels typically, some are quite generic and have a wide portfolio, but I find that most like to add value where they can, and they typically do that by focusing on their area of expertise. So
makes sense.
That would be my recommendation for where to meet and how to connect with angels. And sorry, one other one is seeders. Remember that lots of seeders investors play around and dabble with small investments, but they also have seeders, Crowdcube, all the crowdfunding platforms. They also have a healthy portfolio of serious investors who do browse and see what companies are around. But my recommendation for seeders is to do that after you've already done the work of securing some kind of lead investment. At least 50% of your round should be structured before you go and you look for additional angel investors on the crowdfunding platforms.
Yeah, that seems to be the key, especially the last couple of years, doesn't it? The more lead investment you get, then you build that momentum and that interest.
Yeah.
And then overfund more times than not as well.
Yeah, exactly. Agreed. All right. Where did you guys lose me? Was I through to the world view or not yet?
We weren't on the slide that you've got now, actually. We weren't on. Oh, yes, we were. How to find the perfect investor. Yep.
Perfect. So I'll fly through this, not to take up too much time. But once you've kind of had the meeting with the investor, the last thing I wanted to mention is just this point around the worldview and values alignment. The worst thing that could happen is a year or two into your business, their recommendation for how you should run your company is completely misaligned with your core values. It makes you really uncomfortable. So trying to understand them, not just as, any investor that will invest, just don't think about the transaction alone. It's a relationship. And I think it's a relationship that's extremely hard to break away from. Harder than a divorce, I think a few people say. So it's one where think about how you would make a commitment to a partner. It's really the same level of commitment to these people, because you're going to be in this for the next few years. And what you don't want is a massive values misalignment. making you do something that you don't think you're comfortable with on a values level. So sharing a worldview and thinking about how they add value, those points are the points that I think it's very difficult to perceive that before the meeting. So leave that as while you're having your meetings, don't only just talk and pitch, also listening back to what they're saying, trying to understand what does that say about their paradigm of the world. Just a few quick points from that perspective on what I would have done differently in the company if I could do this all over again. The first one is we definitely raised more money than we needed for the first few years because our costs were far higher than they should have been at that stage. And this was a very difficult lesson to learn. And how you pay for that lesson is in dilution, because you're raising a lot more than you need and you're diluting every time. And the main learnings that we needed to have were happening outside of, let's say, 2/3 of that cost base. So an example of this is, having a sales team of 6 people at some point in the company's journey, when a sales team of 2 would have led to less revenue, lower cost, but we would have been having the same learnings of what the customer needs. Because at that point of having 6 people, the sales per person was far lower than it is now. Clearly, we weren't doing something correctly. And while we were investigating what that was and what the customer needed, we could have been keeping our costs lower. And thinking about keeping costs as low as possible until you achieve what we call product market fit is key. We definitely didn't do that. And then connecting to this point is, if you are burning through a large amount of cash, needing to constantly raise equity investment, then your only tool, your only lever is equity investment. If you are a profitable business or close to being profitable, you can also leverage debt, and debt at a low interest rate. So, and there are modern types of debt now. So it's not just going to your bank. There are all kinds of platforms online that enable startups to access debt as well. But they typically are looking for lower risk businesses that are close to being profitable. So the important point here is, I'm not saying to be a profitable business or a slow growth business versus a high growth business. I'm just saying early on, it helps managing costs. And then that hockey stick is literally around kind of keeping things while you're learning, keeping things quite flat, and then knowing the moment to go and raise, and then moving into a high burn business model. And the other point was, as I said right at the beginning, I definitely spent far too much time as a CEO. I mean, one of your responsibilities as a CEO is to raise equity capital if you're going to be a venture funded business. But if you're doing that 70% of your time, how effective are you in growing the company and managing your team? And honestly, I mean, it's embarrassing to say, but that's probably what the last few years were. I mean, until 2019, when we raised a much larger round and I could really start thinking about the business. And it's if you're going to be the CEO that raises all the time, you need a really great founding team. And luckily, we did have fantastic people in the company that took on a lot of responsibility. But if you're 2 or 3 people and as a start, and one of you is raising capital all the time, then you're really just 2 people growing the company and 1 person constantly raising investment, which is not a great ratio. So I think 25 to 30% should be the maximum. So I'm spending twice as much as I think I should have been as my on a daily basis or over the course of a year. So those are 3 kind of hard lessons that we've learned. And then I'm just going to quickly mention this, but not spend too much time. A lot of people talk about valuation, and I remember trying to be very methodical about valuation and using the reason why I included this chart is I was just using Google Images, and somehow this chart came up, and this is exactly what you're trying to avoid. Just to make it clear, this is not my recommended valuation chart. If anyone's wondering, Crazy. Sorry, quick disclaimer on that. The point is not to do that, and I think for me now, if I when I raise for another business, it will really be just around 3 things. And I won't spend a lot of time on them now, but just wanted to introduce you to the concepts, and you can always research or ask about them more in the Q&A afterwards. The first one is about this concept of thinking about multipliers. So the multiplier is, for your industry, looking at your revenue or your users or your profit, what is the industry typically multiplying that for valuation? So it's just a quick rule of thumb. In our example, we found that consumer businesses, e-commerce businesses, around our size were getting valuations of 2 to 4 times their revenue. So obviously we were aiming for 4 times valuation. The main point I want to make here is I think too many people get get caught up on overthinking about valuation and trying to maximize that to a level which is unreasonable. The rule of thumb multipliers just helps you to position yourself within a space. The real price of the company, the valuation, gets set by the first investor who makes you an offer. So no matter how much you think about it, at the end, it's you're offered a price. You don't set the price. Obviously, if you're a very fast-growing company with a lot of interest, that dynamic changes, and you are more likely to be involved in setting a price because there's so much competition for investing into you. Which is where the last point comes in. If you have a lead investor who sets a price and there's no competition, they have the control. If you're in a position where you have multiple competing offers, then there's more of an opportunity to negotiate. Again, this is a very important point, and we've experienced this. It's important here not to burn your bridges. It's important not to kind of create this overly competitive environment where you just piss off a lot of people and you end up with no investment. So it's a sensitive negotiation play here. We experienced that on the last round to some extent. It was very, very stressful because at any point you think anything that you do or say may really it's a lesson in negotiation which you really can't prepare for until you're in the middle of it, I think. But it was also really interesting to see that dynamic playing out because it's very time sensitive. Everyone wants to lock you in and make you sign exclusivity, and you have to carefully navigate around those timings. So when you get to that point, if you're struggling and you'd like some tips, just connect with me. I can try and share some of my experience on that point as well. So let's project a little bit into where we are, what's going to be happening over the next kind of 6 to 24 months. Really, no one knows how long, but over the next few quarters. Some of these messages that I'm sharing here are inspired by a podcast that I listen to. So I've just shared the link. Fantastic podcast that basically talks about what the investment landscape is going to look like over the next few years. So the first thing is everyone should expect valuations to be lower. There's some really interesting case studies of companies like Airbnb and how they're navigating that, how they've gone out and actually successfully raised capital. But you could see that they understood the valuation angle very well. There'll be a larger shift into focusing on profitability over growth. When I say profitability, I don't necessarily mean that you have to be profitable as a company. What I mean is that your unit economics makes sense. And by unit economics, I mean companies in e-commerce, many of them have been growing the last 5 years in a very kind of bull economy where they've been acquiring customers where the cost of acquiring the customer is more than the profit they make from that customer. But investors have been buying into that story because of the whole narrative of, yes, but they'll come back for a second, third, fourth, fifth purchase and we'll monetize them. And while that probably is true for a lot of consumer brands, the challenge here is that takes time. And if your unit economics require a certain period of time before that third or fourth customer makes you profitable, you may run out of cash before you can see that reality. So that's a very challenging story to sell to investors today. So here, unit economics need to be on being able to show that you can acquire users, customers at a profitable rate, maybe from the first sale. Luckily enough for our business, that our business model has that kind of unit economics. So it works. It's in our favor at the moment to raise on that basis. Again, I mentioned that many investors will meet you, but not all will invest. This will become a bigger issue even now because the purses will tighten for many of the venture funds too. So they don't immediately shut their doors. The worst thing for a venture capital firm is for everybody to think that they don't have money because their pipeline of potential deals dries up. So they'll still meet you. They'll still kind of give you feedback, keep you at arm's length, but they won't necessarily invest. So just be mindful of that. Try and unpack which investors are able to deploy capital by looking at if they are writing checks right now to other companies. Most investors that will still invest a couple of times this year. And another point I mentioned earlier is to leverage government schemes as much as possible. There are some funding capabilities now available for startups that have been released. One of the ones that doesn't get discussed a lot, but if you are developing technology, is the R&D grants, which is basically if you've spent money on developers, or even you as a founder contributing to the technology by being a product owner and giving feedback, part of your salary can be converted into a grant back from the government. I'm not going to go into too much detail on it now, but if you search R&D HMRC grants, you'll find out more about that. And there are companies that will charge you 15%, do the whole work for you, and just basically get you free money. If you're not doing this, this is a massive opportunity. Every single year, we claim a percentage of our losses, and we get that back as a cash grant from the government. And then the last point, coming back to my earlier lesson, is what can you do to change the current cost structure of your business to avoid raising? And this point connects back to the first point, which is if you are going to raise, expect a lower valuation. Is there a way to avoid raising without completely affecting your business's long-term capabilities? So that's something that we're thinking about right now. We know that we have a good backing of investors. We potentially could put together a growth story and go and raise capital now, but we think we're considering this idea of what if we can just not do that this year and come back and raise when the environment is a bit healthier for raising capital. So just 2 comments on winners over the next 2 years. I think the first point to mention is business models. So what does the world need right now? If you're thinking of starting a company, there's going to be a lot more. An example for me, I'm very interested in ed tech. I think that the Facebook of educational technology hasn't been created yet, but I think that with the change in how people consume information and learning going online, I think there's a massive opportunity there. I'm personally quite passionate in education. And if you are in an existing business, how can you make bold, quick decisions to pivot or tweak your business model? Alex spoke about how, just 2 months ago, we were talking about if we're going to meet in person to do this, and just remarkable how quickly he's pivoted and the response he's had in this. Similarly for us, we had to close our showrooms. 30 to 40% of our revenue comes from showrooms. We're now doing half as many virtual consultations as we were doing in physical spaces without that rent cost. So for us, virtual consultations are here to stay. And it's almost frustrating that we didn't do this sooner. So I think it's like, why didn't we already do virtual consultations and access customers around the world? And our virtual consultations, we believe are exceptional in terms of the way in which we do them. They're not just like kind of a stopgap solution that is going to go away after our showrooms open. We're investing into them for the long term. So how can you tweak your business model? I think the winners will be able to do that quickly and boldly. So not just like kind of small solutions, like big, massive, impactful solutions. And then the last point is around resilience. I think over the years, one of the things that we've become really good at is not to freeze up in adversity. We have been in a position where month on month for over a year, we didn't know how we'd pay salaries at the end of the month, and we always found a way to do it. I think that this is a test for your purpose. If you don't really believe in your business that much, you won't fight to keep it alive. So honestly, if you don't, then you shouldn't do it, because it's going to be really tough times, and it's important to really align back to whether you still want to be involved in this company. And again, I'll probably stress this for the 3rd time, but keeping costs low. Everyone has this incentive to grow through increasing costs, and I think that's the right thing to do when your business economics makes sense. But until they do, the mistake I definitely won't repeat on the next company is trying to grow costs out too quickly. Keeping things as lean as possible for as long as possible is one of my biggest takeaways from the last 5 years. To leave some time for questions, thank you guys for having me. Happy to chat through any of those points if you have any questions.
Awesome. Thank you very much indeed. I've got some questions that have come through on the private button here again. Let me just access them again. Question for you is, how have you differentiated your comms strategy over since lockdown has begun? I'm interested to know that as well, because a lot of the CEOs, founders that I've spoken to over the last 6-7 weeks have been kind of stressing the over communication side of things. And I don't know about you, I've also probably never received so much spam in the last 6 weeks from people I've never heard of in my life before. So it is a fine line. But what has your what's your policy been in that regard?
Yeah, it's such a good question. So maybe just two things. Let's talk about comms with our existing customers, because I think that was the most important piece. One of the fears we had with customers who have just purchased a ring, feel comfortable or confident in our ability to deliver on that promise we made. So I think we definitely maybe over communicated or tried to communicate as much as possible with existing customers to protect those sales. So we did tell them a lot about what's going on. We had like photos on Instagram showing our craftsmen working at home, and explaining how that the workbenches could be home. And fortunately enough, we managed to maintain our customers at the same rate as we would have pre-COVID. So we've had a fantastic success there. And then the new customer perspective, I think we initially did follow the bandwagon of everyone else, which is, here's our COVID-19 update and we're washing our hands and this and that. But I mean, we didn't email that's for sure. What we did do is have a little update at the top if anyone wanted to click on it. But then I heard some advice from one of our advisors who used to work at one of the largest brand agencies, and they shared a presentation of how they were advising their much bigger customers to do this. And one of them was just to be human about it. Like the reality is we're doing virtual consultations because we know you're at home. And we were just talking about the realities of your life rather than specifically referencing back COVID. And I think it was just being mindful of people's circumstances rather than that having anything to do with the pandemic itself, right? It's just, we understand that you're at home and we created this experience and we know that you probably will still want to come into the showrooms when they open up. So we kind of made the narrative around our changed proposition to be one where the virtual consultation wasn't there to make customers feel like we're replacing the physical experience of touching the product. However, luckily, some of the customers went, actually, I feel so confident following this experience that I'm comfortable enough to make the purchase. And that's why we've been able to maintain about a 60% revenue level, which is not great. But at the same time, we were at one point wondering whether we'd maintain 10% of our revenues with jewelers around the world closing their doors and supply chains freezing up. So we're really happy with the progress we've made. And also just, again, on the sensitivity on social media, not just continuing, a lot of our competitors are just kind of posting the same strategy. Ours is a little bit more, we just wanted to connect more with people on the human level. So instead of it being very product focused, we tried to go into more stories. So the most recent one is with our head of production, and he kind of references working from home, and he references the challenges that we're facing right now. So it's just humanizing what's going on. I think people are really looking for human connection right now, rather than fancy, glossy social media posts. So that was something that our PR and outreach team thought about a lot when structuring our social strategy.
Thanks, Olivia, for that question. Yeah, I agree. That's been one of my, I did it at a podcast a couple of weeks ago, and one of my personal takeaways from this, and I think there have been, a lot of positives to take away from, amongst all of the negatives, obviously. But for one of me, that has been about reconnection, the people that I've reconnected with that I haven't seen for years. But it was interesting. A number of the people I've spoken to as well on this said, having to, for example, jump on a plane to go and have a 45-minute meeting on the west coast of America, on another continent, and yet now, because people are used to screen time and FaceTime, whereas you're using just audio to do phone calls, you definitely lose something in that translation. But this kind of connection, maybe you lose a little bit, but I think there's definitely more connection this way of doing things, and I do think business travel will have to be reimagined for the future, because I can see that trade, having come from a background of 16 years at Virgin Atlantic, I can see that changing a lot. And a question has come through again from Richard here, which says, any changes in any disruption in your supply or distribution?
Yeah, absolutely. It was extremely challenging for us, and it put our entire business model under question. The biggest challenge for us was possibly, I don't know, most people won't probably know this, but most of the world's diamonds are polished in India, in Surat in India. And actually towards the beginning of March, my colleague and I were in India, and it was just one of these things where weeks later, you can't imagine how oblivious we were to what was coming next. And the narrative there was, doesn't look like India's going to be affected by this. And 2 weeks later, even though their infection rates were relatively low to the rest of the world versus when they decided to impose a lockdown, I think they had the most intense lockdown. It was like 3 hours notice.
Yeah.
They just told people 3 hours later, we're locking down 1.2 or 1.3 billion people. And then that was our entire supply chain got frozen. And that was super scary. So what did we do? How did we react to that? Well, the first thing is we rationalized that most customers buying an engagement ring now are probably not planning to depart for the Maldives in 2 weeks' time. So the concept of a deadline, and this was an assumption, right? We had to test the assumption, but the assumption was that people would be more lenient with timeframe shifting. That was the first thing. And it was just a hypothesis, and it ended up being true. But we theorized that we could increase our lead time, and customers wouldn't drop out as much as they would if they cared so much about the deadline. The second thing that we did is most customers that have committed to purchasing this engagement ring, the design is something that we control, but because the diamonds are accessed from a global supply chain, the thing that matters for them is when they find the diamond that they really like, that's right for their price points and it's beautiful, that they can put it on hold. So even if the production process isn't beginning, we hypothesized that if we could just put it on hold for them and communicate that it was reserved, they would be happy with that, and we would only charge them 10% that was fully refundable. So that created a way for us to still capture the intent of customers without necessarily having to fulfill on it in the short term. And it ended up working quite well for us. So there was about a month between when India closed and when India started reopening. So now they are allowing 10% of those 10% of the staff of those diamond offices to reopen. So there is movement of goods happening again. But for that month, we managed to sustain our customer intent by giving them confidence that the diamond was reserved and we were able to put it on hold. So that was one of the reactions that we did. And then obviously the workshop in the UK had to close for the safety of our staff. We ended up keeping one person going in once a week just to be able to, so 2 people going to do shipments from our team. And that was it. That was the only thing that we had to do. So we had to unfortunately furlough the production team and the sales team because we couldn't deliver on that. We kept just a handful of people on board, and we did our best to try and keep those colleagues engaged. I know it's not answering your question, but obviously furloughing is such a heavy point at this point for companies.
Which has just been extended, obviously, hasn't it?
Yeah, and the way it's extended is great for flexibility. It allows us to bring people back at a more natural pace in terms of the part-time extension. So I think that's giving us a lot of hope for the next few months.
Question here from Stacey, which says, what are the main areas of growth do you see in your industry?
So if it's not already clear, we focus on the engagement ring as a first purchase, but we definitely are interested as growing into different product categories. The reason why we focus on the engagement ring as that first purchase is because the customer acquisition cost is so high online if you're doing your marketing channels that it really takes a large impactful purchase to create a break even on that first sale. However, those customers that we build relations with, it's our vision to kind of create a jeweler for life relationship with them. So we have so much data on what they like that's helpful because most men don't really have a good idea of what to recommend or what to purchase for a gift. So leveraging the insights of that engagement ring purchase, and it allows us to grow out our categories into not only wedding rings as a second purchase, but then after that, additional purchases. And 2 of the fastest growing segments are women buying gifts for themselves and men buying jewelry for themselves. So we think that those customers that we have will engage with jewelry in a way that people haven't in the past, especially because as a company that designs bespoke pieces, we give them that flexibility to have something that they can really co-create with our design team. So expanding into new product categories is a growth channel for us. Geographically, we're very excited about accessing new regions. We expanded to the US, and the US is a fast-growing market for us. But as I mentioned earlier around the virtual consultations, We now think that we can expand to more locations that we hadn't thought about before by offering customers those consultations. And the interesting thing about the virtual consultation is the observation of one of my colleagues who's engaging customers in the consultations is that people who are in London have the virtual consultation and go like, oh, that was really nice, but I probably still come into the store when we open. People that weren't considering going to a store because they're not necessarily in London or in a place that doesn't have that many jewelry options, or were just at a much higher level of excitement that they could shop this way because the alternative for them maybe wasn't as appealing as going into a store in London. So making virtual consultation something that's here to stay is exciting for us. And then from the perspective of diversity, lab-grown diamonds is a very interesting category for us. It gives us access to a different type of customer. It has a provenance story. I know a lot of our customers really care about where the materials are sourced from, and a lab-grown diamonds has that provenance story. But it also allows customers to have access to a larger carat weight. The example I use here is 1 carat diamond earrings could cost £10,000 if they're natural. Lab-grown diamonds don't necessarily have that romance of a natural diamond, but for an aesthetic purpose, if you could pay a fraction of that, even as a woman buying herself diamond studs as earrings, she can have access to 1 carat diamond stud earrings for a fraction of the price. So where lab-grown fits in our strategy is especially around jewelry, not so much around engagement, because it gives customers access to a fantastic product at a fraction of the price that looks just as beautiful.
Yeah, that's really interesting, isn't it, with regards to the online consultations and that barrier, effectively being removed. Be interesting, like the percentages that you'll find, obviously the data that you'll be able to get from that moving forwards. That's really interesting for you. Okay, last question I'll put for you then, as we're coming up to 1 o'clock, is what is your main priority for the next 4 weeks? And I know we've probably got I don't know, however long in lockdown, nobody knows, do they? But yeah, what's your main priority for the business next 4 weeks, would you say?
Yeah, it's a funny one, actually. In the next 4 weeks, my wife and I are expecting twin babies to arrive. So yeah, my priority is very personal, actually. It's to try and extract myself from operations. So sorry to not give you a more inspiring answer you can relate to, but
that's a great answer. What's the arrival date then?
Well, because they're twins, they could arrive early, but if they don't arrive early, it's going to be around the 11th of June. So exactly 4 weeks away.
Exactly 4 weeks. Yeah.
So my priority, which is a priority which I think relates to every CEO should have, no matter if they were expecting babies or not, is how to empower your team to operationally, and even more importantly, but also harder to do strategically, take over from the kind of Swiss Army knife CEO that does everything in the company, so that you can focus your energies on strategy, on culture, on raising investment. So I think we're in a good place. I think we have a great team. So it's not proving too difficult to do that, but it's something that I want to make sure that if the babies arrive tomorrow, we're already in a position where there isn't a key man risk in my absence. Yeah,
that's a really good answer and really relevant, I think, because a number of people I've spoken to who've literally kind of felt like they've been, even Alan Barrett from Grenade, who I was speaking to, got a super successful business being touted as the next $1 billion business to come out of the UK. And he said, he just feels like he's in startup mode again, putting out, all these fires. And you just think, if you can take the advice that you've given like that to actually, be able to extricate yourself from the business while with a minimum, of fuss, I suppose, in regards to the daily business, then the better shape your company's going to be in long term. So that's great. Thanks very much indeed. As I say, I can send an email to everyone who's been registered for this. So if you get the chance over the next, say, 72 hours by Monday to send me anything over, I will then send this out to everybody who's watching, and also those who registered, because we get a lot more replays, obviously people will be watching this next week once we pull this out and put it on our YouTube channel as well. So yeah, if you or one of your team get the chance to do that, Nick, that'd be awesome. In the meantime, everybody, I'll also post up how you can connect. What's the easiest way, people? Obviously, you're going to be under the radar for a while, but easiest way to connect is through the website, I'm assuming.
Yeah, probably. I left my Twitter handle, Nikolay Piri. I've got a pretty unique name. There's one of me. I think maybe there's another Nikolay somewhere, Nikolay Piriankov. So Twitter, LinkedIn, either of those is fine. If you're looking for an engagement ring, then obviously through the website. But if you're just looking for some advice or tips, as long as the babies don't come imminently, I'll be happy to get back to you.
Well, I hope they come then, when they're meant to arrive, June the 11th, maybe that's the best date. So really, really appreciate you taking the time out of your busy schedule to jump on today. And I'm sure everybody appreciates your advice as well. People posting up thank you there as well. So that's awesome. I will let you crack on with the day. Enjoy your weekend. Thank you, everybody. Thanks, Nick. Thanks, Socky. Thanks, A. Thank you for joining us today. And also those of you who are going to be watching this on the replay as soon as I literally press pause in the next couple of seconds. So thank you all for watching. We'll be back on Monday with, I think, at least two live webinars, if not three, continuing throughout next week. And we've now got something like 90 pieces of content, live interviews with experts, with CEOs and founders over on our YouTube channel at Festival of Enterprise as well. And we hope that we will be live soon. We weren't able to bring you Olympia this year. It doesn't look likely that's going to happen in July at all. NEC in October. We'll keep our fingers crossed. But again, who knows? It's a moving feast, isn't it? So thanks again, Nikolay. Really appreciate that, and wish you all the best.
Take care, everyone.
Everybody.
Thank you.
Bye-bye now.